Hey there trader, what's going on you guys? Welcome to another video by Real FX. In this video I'm going to be teaching you about the types of order blocks that we have in the financial markets. Now order blocks are very important because they tell you when to enter into the market and when to stay away from the forex market. Now if that sounds like something that you're interested in, stick around till the end of the video and I'm going to see you guys right after this intro. Okay, now before we continue guys, I'd like to encourage you to subscribe to the channel, to like the video, to share with some friends, as that really helps us grow. It really helps us reach many people and that keeps us motivated to continue making more videos like this. Okay guys, now let's begin our tutorial on order blocks. Now what are order blocks? Order blocks are specific candles in the forex market which indicates where the big participants like the big banks have placed their buys and their sells. Now we take advantage of these candlesticks to know when to enter into the market and when to stay away from the market. Now in this tutorial I'm going to be giving you the three types of order blocks that we have, and with each order block I am going to be giving you a real chart examples of what they look like. Okay guys, now let's talk about the bullish engulf order block or the bearish engulf order block. So the engulf order block is always going to be found at the end of the reversal, so it's going to be the last selling candle before an upward move or the last buying candle before a downward move. So if we have an upward move like this, our order block is around this area here. So the last candle before we started buying to the upside, our order block is somewhere around here, and our order block is always going to be something like this. So it's going to be a candle to the downside. Let me increase the opacity. So it's going to be a candle to the downside followed by a candle that is bigger than that candle all the way to the upside. So this is going to be, let me change this candle to be green. So this is going to be our bearish order block, and when we mark it, we take this tool here and then we mark it from the high all the way to the low. And if this candle has wicks, we mark the high of the wick and the low of the wick, something like this. So when we take this, we mark the high and we also mark the low. Now this is how we mark the order block. This is a bearish engulf order block, and when it's like this, we put our entry on the high of that order block. We put our stop loss just below the low of that order block, and this order block we always expect it to be the last candle before a buying move. So this candle is going to be situated around this area, and then when the market pushes back into this reverses into this candlestick, we expect the market to tap into this candlestick and push to the upside. Now this is a bearish engulf candlestick, a order block. Now let me show you a bullish engulf order block. So the bullish engulf order block is going to be basically the same thing. We're going to be in a downward movement like this, and we expect our order block to be the last candlestick before the selling move or the bearish move. And when it's like this, we know that our candlestick is going to be this size, and then it's going to be followed by a very big candlestick selling to the downside. And this candlestick, let's say it's red, and then if this candlestick has wicks, most of the candlesticks, they have wicks. So if it has wicks like this, when we mark the high of that wick and also the low of that wick. So this is our bullish order block, and then when we trade, we put our buy position here and our take profit just above the high, and then that's how we trade it. Now I'm going to go into real charts and I'm going to show you how we trade this candlesticks. Okay, now the first example is on the Euro UAD, And as you can see, we have the bullish order block here. This is the last buying candlestick before the push to the downside, before this impulsive move to the downside. So when we mark it with what? With the high of it and the low of it. So when we mark it like this, it's going to be our order block. And where is our entry? We put our entry here, and then our stop loss just above it, and then our take profit. Your take profit will depend on your trading strategy, on how you trade. Okay, so this is the bullish order block. It must be at the end of a reversal. It must be the last buying candlestick before a downward move. Okay, now we have the bearish order block. As you can see here, we have this candle here, which is the last selling candlestick before this push to the upside. So we had this retracement, and then we had this push to the upside. This is the last candlestick of that retracement, which means it's the last selling candlestick. And how we mark it, we start from here all the way to the downside like this, and we put our entry where? This is where we put our entry, and then our stop loss is going to be just below it. This is where we're going to be putting our stop loss. And again, your take profit will depend on how you on your trading strategy. Okay guys, so that's a bearish order block. Okay guys, now let's look at the second kind of order block, which is the hidden order block. Now this order block is similar to the first one. The only difference is that we're going to be marking the wick of the last candle, and this is because the wick is going to be very long, that we know for sure that there is an order block on that wick. So this order block has a very long wick, so we mark that wick as our order block. So let's say we have this order block here, we have this candle here as the last candle before this downward move. Let me change the color to be green. So let's say that was the last bullish candle before we had this downward move. Now this bullish candle has this long wick to the upside. Now this is how we mark our order block. When we mark our order block, we're going to be marking this whole wick like this as the order block, and we put our selling position here, and then our take profit just above this wick, and then our target will depend on our trading strategy. Now let's go into real charts so that we can see this thing in real life. Okay, now let's look at this example here. We can see that we had a structural break to the downside. We had a break to the downside here, and then we had a retracement, and this is where we have our order block. This wick over here is our order block, and we know that this wick is our order block because if we dive into a lower time frame, we are going to find an order block within this wick over here. So if we dive into a lower time frame, we're going to find an order block here. This is why we say this is a hidden order block. So we take our trade here, we're going to be looking for a sell, and then we put our stop loss just above this, and your take profit will depend on your trading strategy. Okay guys, the last kind of order block is called the breaker block. Now the breaker block is an order block that has failed to hold, so it's either one of the first two that we talked about. So if it fails to hold, it now becomes a breaker block, and there's a chance that the market might return and then use it to push either to the downside, to the upside. Now let's say we were having a structure like this to the upside. Obviously our order block is around here. It's gonna be the last bearish candlestick before a push to the upside. So this is gonna be our order block. Let's say instead of pushing to the downside and then pushing to the upside, the market, instead of doing this, the market violates our order block and then continues to move to the downside like this. Now this becomes our breaker block. Now we mark this order block here for an opportunity to continue selling to the downside. So we expect the market to retrace, tap into this breaker block, and then push to the downside. Now I'm going to go to real chart, and then I'm going to show you this kind of breaker blocks. Now let's look at this example here. So the market was pushing to the upside, as you can see here. The market was pushing to the upside. We were making higher highs and higher lows, and then this order block here, failed to hold, to push the market to the upside like this, and the market violated this order block. Now this order block now becomes what? It becomes our breaker block, and we mark it as our breaker block. We expect the market to retrace and then continue to push to the downside. As you can see here, the market went through this order block, it created this low, and then it retraced into that order block and then continues to push to the downside.